Greetings. Hey, Brad at what is probably one of my, might be my favorite YouTube investing channel right now, which is his channel at Income Architect. Um, he did a video the other day and surprised me with announcing that he had sold all of his Roundhill funds. So that would be uh, popular ones. Certainly, they have more than this, but ones that a lot of, that get talked about a lot are QDTE, XDTE, and RTTE, and those are of course the covered call funds for the Nasdaq, the S&P, and RDTE is the new one that covers the Russell. Um, and he had some good points in his video, but one of the things he noted was that one of the reasons he was selling was that he felt they had been overpaying, and he specifically noted since first week of August. I think that was the week that we had the great carry trade unwinding. And everyone was affected. Of course, things recovered very quickly after that. Um, but regarding the overpayment part of his concern, I'm really not alarmed by that, and I kind of want to show why. And so, for purposes of this video, we're just going to focus. We're just going to take a look at QDTE. If I get time later, I might go through and evaluate the others. But let's start. QDTE is Covered Call Strategy Fund from Roundhill, covering basically the Nasdaq 100. They don't call it that because they didn't want to pay the licensing fee to use the term Nasdaq, so they call it the Innovation 100. But it's the Nasdaq 100. So if we look at this, one of the things that has made the Roundhill funds popular and gotten some attention was that they appear to have been performing better from a net asset value perspective on distribution. So the perception there is that they're giving us less of our own money back, and that they haven't been overpaying based on their earnings. Brad, and again, I can't even express how much respect I have for Brad and the time he's putting into his videos, and I think it's just one of the smartest uh, channels out there right now, and he doesn't make our eyes bleed watching him fill in his spreadsheets in real time. But the so if we look at this, we can see that when the fund first launched, we were up around the $46 range, and it's dipped and gone up and down. But uh, for the most part, this fund has held its NAV well and has been paying really good distributions. The number here at Seeking Alpha, I don't think fully represents that. That's got to be like a year to date number, since the fund has only been around. I want to say right around 7 months or so. Well, let's see. We're back in March, so we're yeah. So the thing I want to focus on here, though, is that we've got assets under management. So that's 471 million as of right now. Um, and if we look, at the underlying that this is based on, so this is the NDX, we can see that in the last 6 months or so, we're up about 11.5%. Let's just call it 12% for even numbers. My expectation on these funds is that they absolutely outperform the index. That's the whole point of trading options and covered calls on these things. Yes, it's income generation, but if we're not hitting 30%, over the long haul of numerous transactions, again, you're doing this over a long period of time with lots of transactions, I expect to hit somewhere in the 30%, give or take. And if someone can outperform that, great. If someone slightly underperforms that, that's fine. But I expect these funds to significantly outperform the indexes. Otherwise, just buy the index, right? I mean, yeah, you want the income these are generating. That's fine, but the whole point of doing of trading the options on these things is to do better than just buying and holding. All right. So that being said, there's underlines here that they're going to have to dispose of, and Brad alludes to that in his video, and I think he has an extremely valid point about the fund management not being able to articulate a plan for how they're going to close out the underlines yet. Uh, if they were to close that out today, though, I would expect there to be a net gain on that underlying position, and based on the market appreciation minus the theta decay, I would expect there to be a gain and something uh, additive to the distributions. I don't know if that's how that gets handled or not. Feel free to comment or correct if I've got my thoughts on that wrong. Um, Regardless of that, so I went and I looked at data, and I went and did this using some data available at the Reaching Riches channel. This is another one that I subscribe to, and that often has some really, really good content and some really good tracking going on. We'll expand this up a little bit. I think it's still not going to be particularly easy to see, but um, so I took the data that had already been tabulated here, where he's just basically tracking the trade windows, the declaration of X and pay dates, how many shares were outstanding. And the important piece here is the dividends per share and the actual dividends declared and paid. And if you look up here, if you look at the top right, I don't know if we're going to be able to see that or not. But if we look up here, you can see, I can see anyway, that the total actual payout was approaching it's almost 25 million. The gross total premiums paid is almost 24 million, but there's a variance here of just a little over $1 million that would suggest that they had overpaid. Okay, so now let's get in and let's look at the numbers a little bit. Okay, so taking a look at that data, just formatted differently here. We can see that starting back in March with the first dividend declaration, we had 42 cents earned. They paid 36 cents, so theoretically, they held back in the positive about 6 cents. And as we go through and we track this over time, so we have the earnings, how much was paid, and then we do a cumulative count of both, and we just track the variance here. We can see you get into May and early June. They would appear to have overpaid by a fair amount. And then we see here going along, they get back into positive territory thanks to what appears to have been a 76-cent earnings for that period, and a payout of only 23 cents. So that put them back in the positive by 34 cents that had yet to be paid out. A couple of quick points I just want to make sure I note is that the weekly premium earnings may not be based on a Monday to Friday window. I can't remember which fund manager it was. Somewhere I thought I heard someone say that it was some offset cycle. It might have been like a Tuesday to Monday kind of thing or something like that. I don't know if it was these funds or not. For our purposes here, though, just tabulating this data week after week after week and getting to a bottom number over time, that offset doesn't matter. It doesn't change the outcome, because we're actually just accumulating the day's transactions. However we box them in week to week doesn't matter so much. The other thing too is that the payment window is, if I understand correctly, per the fund manager statements, offset by 2 weeks. So the payment is based on what they earned 2 weeks prior, perhaps. I believe I've heard that specific to the Roundhill funds. I know. Hopefully, I'm not wrong with what I heard or what I believe there. Again, it might change how we present the data. If I were to go through and offset these numbers, it doesn't change how they tabulate, other than we might be missing a week or two's worth of data from a payment perspective. So I felt it was important just to clarify that. We get into, Brad specifically mentioned first week of August. We can see here, there was a 48-cent earning. They paid out 51 cents, but we're still a penny. If you track all this, they were still a penny positive from a payment perspective. And then the next week, huge 94-cent earnings. And you can see here they paid out 47 cents, underperformed the next week, but was still able to pay out 30 cents more than they earned and still be in the positive. So present week excluded, which is today's the ex-dividend date for QDTE, XDTE, and RDTE. This would show that they've overpaid by a couple of cents, which, it looks like at the peak, maybe they had overpaid by about 19 cents. Okay. This is just based on the options earnings. There's a couple of other considerations that have to be factored into this. One is that almost about 10% of their holdings presently are in a government bond fund that pays about 5%. So there would be additional earnings coming in from that. I believe offset from that by maybe double, though, would be the fund's management fee. So and at this point we're talking about pennies up to this point. The earnings on those government bonds would have been a couple of pennies, maybe 2.2 cents or something like that at this point, I believe. Again, this is without going back and tracking exactly how much of it they held over time, all of that kind of stuff. So I'm not worried. The fund's goal is to pay out the earnings, but they may make a decision to underpay, overpay. I mean, they can dole this out over time, I believe. I don't think there's any restriction in them doing that. And again, in the 19A forms that come out will show how much might be return of capital versus actual gains on the investments, those kind of things. How much might be long-term, short-term, all of that. Payments from a lot of these funds are based on what they're expecting to happen. I mean, yes, it's based on the reality of the current set of transactions, but they also may be trying to manage what they're paying out to keep it relatively consistent. And to use an example of that, they had a really, really bad month. And the 10 cents wasn't the worst one, I thought. There's a 9 cent right there. So this is back in April, where they had 9 cents. They only paid out 9 cents. They were actually ahead by a nickel. They could have paid 10 or 11 or 12 and still been ahead, and they didn't do that. That actually gives me a little bit of faith and confidence that they are responsibly managing these distributions. Again, it's just my opinion, could be completely wrong, but I'm not going to fret about a 2-cent overpayment over 6 months because eventually it'll go the other way, right? It'll swing back to where they're positive versus negative, just like it has in the past, I expect. And again, I could be completely wrong. So at this time, anyway, I'm not worried. I think Brad brought up some very valid points, especially about them not being able to articulate a plan on how they're going to close out the long positions for the underlines. That being said, though, I still think we're in good shape on these funds. I actually picked up more shares this morning since it's the ex-dividend date. This last week, I was mostly picking up GDXY shares because they also we're going ex-dividend this week, and that only pays monthly. Today, though, we're ex-dividend on QDTE, RDTE, and XDTE, and I am looking to continue to build positions on those. So anyway, please in the comment if I'm thinking about this or looking at this the wrong way, just let me know. Otherwise, hope everyone is having a fantastic week and take care.